What's up, everybody? Mortgage rates seem to be finally coming down after the Labor Department issued its monthly jobs report with a shockingly low number. Just 150,000 jobs were created last month, 20,000 fewer than forecasted, and barely half of the 297,000 gain seen in September. But is this an artificial number due to the amount of strikes going on, specifically by auto workers at Ford, GM, and Stellantis, as well as the actors' strike, which has been going on since May? The economy technically lost 35,000 manufacturing jobs in September, but nearly all were in the motor vehicles and parts sector where workers are striking. So does this mean that the Fed will finally stop raising rates, or is this simply a temporary relief in rising mortgage rates due to the recent jobs report? And how does this affect home prices? Today, we'll take a look at an article by Will Daniel and Irina Ivanova for Fortune titled, "Mortgage Rates Are Dropping Fast After a Shock Jobs Report Set Off a Series of Dominoes on Wall Street. The Housing Market Can Thank Detroit's Striking Auto Workers," as well as Redfin's latest housing market update to see what they're saying. We'll also touch on that big verdict against NAR, the National Association of Realtors, as well as several real estate brokerages, ordering them to pay almost $1.8 billion in damages after finding they artificially inflated commissions paid to real estate agents, and how that ruling could impact future buyers. And as usual, I'll chime in with my opinion as well. So let's dive right in. In the Fortune article, they report that the average 30-year fixed mortgage rate fell below 7.4% last Friday, its lowest level in 2 months, relieving some of the pressure of the housing market. Mortgage rates tend to track the 10-year Treasury yields, and that plummeted on Friday, illustrating that investors could anticipate interest rate cuts from the Federal Reserve. But is it too soon to celebrate lower interest rates? Will this job report be enough for the Fed to stand back or even consider lowering rates heading into 2024? Score another goal for the Fed. Ronald Temple, chief market strategist at Lazard, said of the latest labor market report, arguing that weaker than expected jobs and earnings growth are evidence that inflationary pressures are cooling. This news affirms yet again that the Fed should end the rate hike cycle and can shift now to contemplating what conditions would warrant the first rate cut in 2024. A rate cut would definitely help buyers in this increasingly unaffordable housing market. But what about home prices? According to Redfin's latest housing market update, nearly 7% of the homes for sale had a price drop in the 4 weeks ending October 29. On average, the highest portion on record. Regardless, sales prices are still up 3% from a year ago. That's partly because sale price data is a lagging indicator, meaning it's still showing data from sales that went under contract a month or two ago. Growth in sales prices may slow in the coming months as it starts to reflect houses that went under contract as interest rates hit 8% in October. Another reason for rising sale prices is that despite demand being down, low inventory is keeping home prices high. Redfin reports that the total number of homes for sale is down 10% year over year. New listings are up 1.1% from a year ago, just the second increase since July of 2022. But that's partly due to new listings falling quickly this time last year. And according to Realtor.com, in October of 2023, there were 737,480 active listings on Realtor.com. That's 2% below October of 2022. However, it's 30.5% above the height of the pandemic housing boom in October of 2021. But it also pales in comparison to pre-pandemic levels. Active listings in October of 2023 were 39% below October of 2019, when there were 1,208,001 U.S. homes for sale. During the pandemic, what was happening is that new listings volume was pretty healthy. There were plenty of people coming to the market for sale, but the velocity at which they were selling was so fast that it was drawing down the inventory. Now it's completely flipped. The pace to draw down inventory on a percentage basis is healthy, but there is just no one selling. The new listings volume has just crashed, Dobson tells Resi Club. Would-be sellers simply do not want to give up their low interest rate to then go buy something with a much higher rate. Low inventory equals competition, which results in high home prices, at least for good houses. And by good houses, I mean those houses that show well and are priced right. Redfin reports that the median asking price is up 5.4% year over year, the biggest increase in a year. 38% of the homes for sale sold in the first 2 weeks, up from 34% a year ago. And 30% of the homes sold above their list price, up from 28% a year ago. So home prices are still high, causing one of the worst affordability housing markets in history. But let's get back to interest rates. Will this latest job report cause interest rates to finally start to come down? Or is it simply artificial due to the strikes? Daniel and Ivanova reported that while the United Auto Workers strike accounted for a major portion of the misfire, some experts believe the job market was already cooling, noting that September's job creation number was revised down by 39,000. Although this month's number is artificially and temporarily lower because of the striking workers, which will be added back in, the revisions lower in prior months exceed the size of that adjustment, potentially showing a true cooling trend, even when accounting for the striking workers. Chris Zaccarelli, Chief Investment Officer for Independent Advisor Alliance, explained. Kathy Bostanek, chief economist at Nationwide, echoed Zaccarelli's comments on Friday. Even accounting for the auto strikers, which were a drag of 32,000, there is a clear downward trend in employment growth. The cooling labor market will likely help boost markets and lower mortgage rates as investors anticipate the end of the Fed's rate hiking campaign. Before the latest jobs report, housing market affordability was so bad that Zillow estimated it would take the average buyer 13.5 years to see a return on their investment. That's more than double the historical average of roughly 6 years. So in essence, the workers' strikes may have impacted the housing market in a positive way, although clearly that was not their intention. Still, it's only good news if it lasts and the Fed stops the rate hikes. According to the SAM rule, a metric named for former Federal Reserve economist Claudia Sand, the rise in unemployment rate has been so steep that the economy now sits a hair's breadth away from recession. And while a recession would certainly bring home prices, asset prices, and other measures of inflation way down, it would also plunge many more Americans into misery. A recession would likely bring mortgage rates down considerably, said Redfin economist Chen Zhao, but it would also remove some people from the home ownership path if they lose their jobs. It's all so very depressing. Either housing market remains unaffordable to most people, or if enough people lose their jobs, rates will come down and make housing more affordable. It just sounds like a lose-lose to me. So let's touch on the ruling of the class action lawsuit that was filed in 2019 on behalf of 500,000 sellers in Missouri and some border towns. The verdict stated that the defendants conspired to require home sellers to pay the broker representing the buyer of their homes in violation of federal antitrust law. Now, I don't know what the real estate contracts say in Missouri, as each real estate market is specific to their jurisdiction, contracts, and culture. Regardless, this judgment will impact the real estate industry as a whole if sellers choose not to compensate the buyer's broker, as many buyers will simply not be able to afford to have their own representation. We just went through all the data showing how unaffordable the housing market is right now. If buyers have to come up with even more money in order to have representation, it will only exacerbate the affordability crisis. Or buyers will choose to be unrepresented, which just seems to be very unfair. Here in Maryland, a realtor cannot represent both the buyer and seller in the same transaction. So if a realtor represents a seller and the buyer doesn't have his own agent, the buyer's needs will not be represented nor negotiated in the buyer's best interest. With a changing market and money and housing being so expensive right now, shouldn't a buyer have the best representation when purchasing a house? Should they have to come up with even more money to procure that representation? What are your thoughts on the ruling? Do you think buyers should pay for their own representation? From what I understand, the judgment will be appealed. This matter is not even close to being final, as we will appeal the jury's verdict, Mantell Williams, a spokesman for NAR, said in a statement. In the interim, we will ask the court to reduce the damages awarded by the jury. Williams said it'll probably be several years before this case is resolved. But I think we'll know more in the next couple months on what will happen on everything we spoke about today: interest rates, home prices, and the future of the real estate industry. If you missed last week's video on several experts' prediction on the future of mortgage interest rates, definitely check that out next. Thanks for watching. I do appreciate it. Coming from New York City this week. Bye!